fit it in. It's part of the revision.
I guess so. Fresh insights. How was it? I hope it was good. It's done anyways.
It's done.
It's Ola now. Come on, what are you talking about?
No, but you know what? I've realized how when you do a master's in finance, sometimes you can come out with knowing more mathematics and finance because it's like so much calculus and so much statistics. I'm like, don't I know bankers in this country? Do they know this math? So yeah, but it's
how can you live life without mathematics? What's wrong? When you
this one it looks like statistics. It looks like calculus.
When you're driving, you use mathematics in your head to calculate the distance between you and the next car, the next turning.
It comes naturally.
Math, it's a natural phenomenon in your life.
It only becomes natural when you've left school and you stop writing exams, honestly. When you are in school, there's not natural anything. You stop. We can't hear you, Ndidi.
We can't hear you. You're on mute.
I can see that the participants can already smell the abundance of Efikoism in the room. So this is what we are going to have to deal with.
How did I get to agree to Yewande?
Yes?
How did I agree to sit on this panel?
Because you knew as usual, you'd be around correct people. You're used to being surrounded by powerful women. Jalo, don't come out.
We're family now.
Okay, so we're ready to go live.
Okay.
All right, so, I mean, that was a great starter. And welcome to everyone. Happy Independence Day, Nigeria. I mean, Nigeria is turning 60 at a time when the world is dealing with a truly ugly pandemic. 71 million people are projected to go into extreme poverty and 100 million more below the poverty line. So everybody really is struggling. And I think today we're here to lend our voices to how Nigeria emerges as a nation to her new normal and becomes a nation that truly works for the entirety of its citizenry. You know, I'm really, really pleased with the panel that I have, people wearing multiple hats. I'm excited to be the moderator and not a panelist. Like I said to Haruna, that I am the traffic warden. So I'll just be playing you up in and around yourselves and getting the data together. So today we're going to be moving forward discussing how do we utilize our indigenous capital instead of going out and borrowing as we would usually do. If you followed the event from the platform, Mr. Teto Peterside touched on it, Lamido Sanusi touched on it, Jared Cohen touched on it. In fact, Pastor Kojo was just saying to me that your session is a follow-up on the session today. But you know, one of the exciting things for me is this follow-up is with the very best of Nigeria's human assets. And I will start by introducing one of four panelists, Mr. Haruna Jalo Waziri, who is currently Managing Director of the Central Securities Clearing System. He was immediate past Executive Director, Capital Markets for the Nigerian Stock Exchange. Thank you, Haruna. We're really, really pleased to have you.
I'm very, very happy to be amongst beautiful men and discussing how we can make Nigeria better from an investment perspective.
Thank you. Second on the panel is Dr. Ola Brown, the flying doctor herself. What a lot of people don't actually know about Dr. Brown is the fact that she is a finance enthusiast. I think that people realized when she started to talk capital markets and mathematics, and later I think people can ask you how you did the crossover. But for now, we're going to focus on the fact that she has become a professional indeed. She's an author, both in the medical space and in finance. And I am truly excited to have my friend in the house. Welcome, Dr. Ola.
Thank you very much. I'm really excited to discussing this really important topic.
I have another heavyweight, Abiola Ojo-Osagie. 21 years she is bringing to this table. Over 15 years in Philips Consulting, where she rose to become associate partner. Today, she's managing director Chief Executive of Afric Invest, which is based out of New York. She's MD in Nigeria and senior partner at the firm. It's a PE firm. Abiola, we're happy to have you. You're welcome.
Thank you very much, Ndidi. I'm really super excited to be here and to be discussing alongside other extremely erudite panelists. Thank you for having me.
Last but not the least is someone who I have admired in my 20-year career. Honestly, Yewande, you can't know how much I have admired you. Honestly, so admired you. I call her a legend in banking. I know she's going to be humble. Yeah, I take it, but Yewande, really is exciting to have you here. She's currently the Executive Secretary and CEO at the Nigerian Investment Promotion Commission. She was Chief Executive of Investment Banking at Stanbic IBTC. Yewande, thank you. And I'm going to seize the opportunity to say immediately after this, you are in my debt. You owe me lunch, and that's by force because I have to sit with you. You're welcome.
Thank you. Thank you very much.
Okay, so we're going to dive right in. And my first question really is about the type of capital that we're attracting as a nation. Today we see that PFI's inflows are significantly higher than FDI, which are more long-tenured funds. Even though both funds are dwindling, they're just not, I mean, FDI is really what we need, not the PFI flows. Yet we still see monies coming in attracted by our technology space. At the same time, we see our own indigenous, our own citizens struggling to move their own monies out. What do we need to do? One of the things that has even worried me is a lot of foreign PE firms in the Nigerian space. Where are the indigenous PE firms? What do we need to do differently? This question is for everyone on the panel, but I think I'm going to start with Abiola because she's in the PE space. Maybe she can tell us why the indigenous PEs are not in the race.
Okay, thank you, Ndidi. I think that you are actually speaking to the heart of a fundamental question relating to the role of what I would call price mechanism in resource allocation. And that's simply saying that, I mean, to your question, why have we kind of taken more of FPIs than FDIs? And why are the local or the indigenous capital not working or sweating it out locally? And but what I like to just put some context to that, because I think it's important for the audience to understand what we as a country have done in the past. Some of this we're changing right now, but the context is very important. So as a country, we have used FPI as a source, as a tool, you know, for currency, and sometimes we've used it as a reserve management tool, you know, and it's for many reasons. And we know that FPI, some people call it hot money. It's there, but when things don't go right, of course, they leave very quickly. I mean, just a couple of months ago, we read in the papers how many of them were looking to take out the money, and you know there was no currency, CBN wasn't giving them, and all of that. So I know the regulators have tried to solve this problem somewhat, still talking about context, but in solving it, they have also created another problem, because when they banned this and banned that, the PFAs and the individuals from participating in OMO, for example, alternative instruments, you know, basically the yields declined, and so there was just a lot of money in the system looking for outlets. So, but I think the fundamental problem, honestly, it's really about the investment climate. Whether it's FPI or FDI, it's really about the investment climate. And when I talk about this, I'm talking about the fact that, and as Joe alluded to this morning, private capital is not charity. No, it's not charity, and we need to get that really straight. So when we talk about inflation-adjusted returns, what are we today? Inflation is around 13%. And when you want to attract capital from local investors, the local investment would have to, you know, at least provide a risk-adjusted return in excess of inflation. That's the truth. You know, over the horizon that they're looking at, so it could be 2, it could be 3, it could be, we're talking long-term, so minimum of 5 years. But currently, the highest yielding instrument that comes up close to this for such people really is about 9% for the longest dated bonds. So you find that investors, mainly local investors or indigenous investors, they typically rally around government securities. So if you want to have them not do this, but to look at alternative investment options, which you will find the FDIs play in, then they have to be comfortable with taking the investment risk and getting their money plus some returns. The truth is that Nigeria itself can be somewhat risky. I'm an investor and I know that. So when you find local investors trying to find ways of hedging and trying to find outlets for their funds, as opposed to what you refer to as foreign investors. Foreign investors, they invest in foreign currency and they try to hedge it in some of the agreements that they make with some of these companies. But where Naira is being invested and the risk-adjusted return doesn't give what should, ordinarily give you that markup, there's no incentive to invest. And for me, that's the fundamental problem. But I can speak, if you would like, to some of the solutions, because I think today we're 60. We shouldn't just dwell on problems. We shouldn't just be looking at, okay, what are these challenges? Challenges have always been with us, but there are low-hanging fruits and there are things that we can do, perhaps to change this narrative. So the first would be really for the regulator to introduce some incentives. That will increase investment and investment participation in maybe starting with the local equity market, because even when you talk about the local equity markets, you find a lot of companies with high return on equity, but this has not really crystallized into participation in their stock, and it's a myriad of reasons. I mean, Haruna is there, Yewande, they will speak to all of that, starting from low financial literacy to the fact that there's no trust in the system. But if you create a system that is robust enough, I give you an example. Recently, 3 East African countries, Tanzania, Uganda, and Rwanda, they came together and they merged their stock markets. And the reason they did this is so that they could provide a large pool of capital and investors, essentially. And the idea is that when they have this kind of merged stock exchange, it will provide liquidity and some level of price discovery for local investors and even foreign investors. So maybe Nigeria, perhaps it's an idea, we could follow suit and look at other West African countries and create a robust, because even the capital market has a way of galvanizing and harnessing some of this indigenous capital that you speak to. Of course, it has its own regulatory things, talking about accounting standards, automation, and all of that. But these are things that can be surmounted. I'll just speak also about the macros. I mean, there's no way we can talk about investment climate and not talk about the macros and de-risking, and which, I mean, it was interesting listening to Atedo this morning, to be honest. He spoke my mind. We have to talk about the macros and de-risking for investors, because local investors must achieve real returns. I speak about returns. It's really the basic thing that any investors, if that is there, a lot of people would participate, but because it's not an emotional thing, it's common sense. Return on local investment must be greater than the return on the investment that you find in FPIs. When FPIs invest in Omo and all of that. Otherwise, there's no incentive. I don't know if you want me to stop there, but I mean,
I want to go right to Yewande, because you talked about trust, and I know Atedo spoke about government de-risking the investment by probably providing guarantees. If there's no trust, how do you want to embrace that guarantee? And I'm going to throw it right at Yewande.
Government providing guarantees is one option, but government providing guarantees, I don't believe is necessary with the right investment climate, because the value of guarantees that government can provide in any and all circumstances will always be limited. Ideally, you want a private sector that is much, much larger than the public sector. What government needs to do is provide what private sector continues to ask for, an enabling business environment. We need investments across all spectrums, whether it is foreign or domestic, whether it is portfolio or direct. I see all investor classes as different stops along a spectrum, of what you need from investors. And if investors have the right business climate that is conducive for capital, that does not threaten their capital, they don't need any guarantees. The first comfort that investors need is that they will get a decent return from operating in that market. If there's a dispute in the course of their investment, that there are legal protections, and that both parties will not only honor what is written, but if they try to get a resolution, they will find justice quickly, not the one that will take forever to do. Then the quality of the returns that is possible from the market. I've always thought that the first incentive that investors need is just the ability to make a high, as Abiola says, a risk-adjusted return.
Mm-hmm.
If all those things are in place, what guarantee is government providing other than we will not disturb you? In fact, that's the ideal guarantee. We will not put any red tape in your way. We will not disturb your ability to make a return. And we will insist that your investment, at NIPC, we like to think that investments should meet 4 parameters. They should be responsible, they should be inclusive, they should be balanced, and they should be sustainable. We think it's important that when you think about generating capital for Nigeria, that you're thinking in the context of sustainable development goals, because capital that makes money for investors is not enough, even though the primary reason that investors invest is for returns. And in reality, we want investors to be resoundingly successful. It's only investments that generate the appropriate returns for investors that will pay their taxes, that will grow their business, that will hire and keep hiring. But government has developmental objectives that government would like to achieve. But I personally, believe that government providing guarantees for investment says already that you will limit the quantum of investment that is possible. But if government provides the right kind of assurances, and those assurances have to be around policy stability, especially for direct investors. As Abiola says, portfolio investors, it's easy for them to come, it's easy for them to go. When their policy changes, they can react very quickly. A direct investor doesn't have that same flexibility because his investment horizon and his return expectation are much, much higher. So the policy positions of government affect investors in different ways. But the stability, investors don't like surprises. They like to know that when they invest in a market on the basis of this is how the market operates, that they will get that when they participate in the market. So certainty of government policies, certainty of government behavior, certainty of application of the rules without ambiguity. If they're difficult, just let us know what they are and apply it to all. But in the context of providing guarantees, I'm not really a big fan of guarantees unless it is in limited circumstances and only to remove some risks that the market opportunity does not.
Very interesting. And you know where this is going for me? The chicken and the egg scenario. Which comes first? Because, throughout the platform today, I've heard a lot of talk about people being bold enough, coming out to exercise their rights at the ballot box. And I think that is only how the changes really happen. Haruna, I want to hear your perspective. We want government policy to change. I mean, it is still us, ultimately. I don't know. So Haruna, over to you.
I think, between Abiola and Yewande, they've dimensioned what would be necessary in terms of the description of what we need to do. But let me try and put in context what both of them are saying. So when it rains, right, if you look at your house, right, you find out that where water collects is the lowest point, correct?
Yeah.
Capital is like that. Capital will find its best spot to stay. And capital will look for only one thing, protection. Before you even go to return, capital needs to know that I'm protected. Protected from 3 things: institutional, and then you look at return, and then also sustainability. Yewande talks about SDG. But capital on itself has all of those components. So it's like rainwater, it's like water, it finds its lowest point. You have to have that point. If you don't, if you rent, that water will never stay. It will run away to the lowest point. That's how capital behaves. Now, for us to even talk about all of that, we have to ask ourselves 3 key questions. If I'm looking at Nigeria, let's start with numbers. What is the size of capital imported in recent time? What is the size of domestic investment compared to foreign capital? Because there's a correlation between what you have locally and what comes in. And I'll expatiate on that later. The last question is, how can we improve domestic investment? Let me explain further. Yewande, you remember when you were in Stanbic, I was in UBA trading, right? So the foreign investors will give me an order and they will tell me, don't do more than 20% of what market is doing for a particular instrument. What that happens, it limits the amount of investment somebody is willing to, so he's de-risking himself and saying, look, I want the market to do 80%, but I will do 20. Now, if you're doing 100, you do 20 naira. If you're doing 200, you do 40 naira. If you're doing 500, take the numbers away, take it on an exponential basis. So what is really very important, if you ask me, around what investment is, which Yewande alluded and also Abiola, it's not about guarantees, it's finding the right space, the right environment, the right policies, the right institutions, the right protection, not guarantee. So there are 2 different things. Guarantees don't really work, they work to a limit. But what you need is an environment. You need the partnership from a local to foreign. And then when you create that pool that sits in that, lowest hanging point, which is where it's protected, you unlock a lot of things. 2, the confidence comes in, the ability to spread the industries where you make investments, and then they become more risk averse and now put more into it. But the first thing you need to do is protect that capital. Find that water hole, make sure it's safe, make sure everybody knows the rules around how it happens. Now, one of our biggest challenges is interpretation of contracts. Today, you and I can enter into a contract. The contract is as good as how we want to behave. When we go to interpret the contract in court, by the time we finish the case, I have lost money, you have lost money. So these are the things that need to be put in place to ensure that capital is there, keeps coming, it's protected, and then it helps achieve that growth that we're looking for in this country. Thank you.
Interesting. So finance has now gone to law. Ola, take it away. We're now in the space, in the legal space. And I think we're once again speaking to, I think it was Dr. Ojo-Osagie who spoke about there is a need to re-engineer and get a new constitution. The constitution we have today in Nigeria is not a platform on which we can build a lot. So what would you like us, government, to do specifically? And in the legal space in particular, what do you want to see differently? I mean, you're an entrepreneur, so you have lived it.
So I think the topic of indigenous capital is fascinating. And throughout my research in finance and economics, I've been trying to focus on Nigeria. So literally, I couldn't even switch on my camera at the beginning of this presentation because I was just submitting an essay on capital controls and indigenous capital in emerging markets. And I think that there's 4 main factors that I'm going to talk about. Number 1, I think when we talk about indigenous capital, like Mr. Jalo said, we have to consider, how much indigenous capital actually exists. Because I think that over the decades, we've kind of told ourselves that Nigeria is rich, that there's so much capital, it's just people taking it out. But actually, if you look at the net worth of the Aliko of India, I looked at it just now, his net worth is $85 billion, Mukesh. The Aliko of Nigeria's net worth is $8 billion. And that is the class captain, the richest person in Nigeria. So really, our levels of wealth are very, very different. 90 million, over 60% of our population are extremely poor, compared to just 5% extremely poor population in India. So first we have to consider, okay, how much indigenous capital, how much people are not even spending all their money on food? how much indigenous capital does it actually exist to invest? So once we've asked ourselves these questions and we've actually highlighted, the proportion of the population that actually have the capital to invest, then we now start to think about why or how we can change the structure of Nigeria to really be more open to indigenous investment. There are two types of economies. There are bank-orientated economies and there are stock market-orientated economies. 30% of the capital in American households is in the stock market. And that's why you see, because households, normal people, they're a bit more risk, they like risk more. They're a bit more risk, they're a bit more adventurous. So that's why you see all the most innovative countries, or part of the reason why you see innovative companies like Uber, like Google, like Tesla coming out of America. Because a bank, ideally, would be too conservative to say, let me go and invest in what does Elon Musk do? Electric car, 10 years, nobody's going to do that. Or, car that will be driving itself. Only household people think of that. Banks, they want to see your EBITDA, they want to see your cash flows, they want to see everything, they're very conservative. So when you have a bank-orientated economy, historically, they are not, according to the evidence, they're not as innovative, or they're less associated with innovation than a stock market economy. So how can we become more stock market orientated? I think that there are pools of capital that we can use and put into the stock market. We can change some legislation, like we have a big pool of capital in the pension market. If we can make the laws more flexible to put that in the stock market, then it will raise the total amount of capital in the stock market. And there's also a lot of work to do around financial literacy. Make sure that that small amount of the population that does have money to invest can invest in the stock market and can, raise the capitalization of the stock market. I think we've spoken about enough about the macro, so I won't go there. I'll speak briefly on guarantees because I think that's really interesting. The only real guarantees that we have of capital in Nigeria, apart from the sovereign guarantees that are occasionally given to investors, are the Nigerian deposit insurance. So our deposits are partially insured. But even then, it's actually very, very difficult for the Nigerian government to insure all the depositors. And it's just like 50,000 naira or something like that. But it's very difficult for the federal government to insure even that tiny amount of money. When I first heard that actually only 50K or 100K is actually insured, I was very afraid. But I realized that I did the math and I said, this is actually a huge amount of money for the Nigerian government to take on its head and say, okay, we're guaranteeing this amount of money. So really, when you're talking about multi-billion-dollar investors coming in and you want a lot of that investment, how is the government going to insure it? We're still struggling with the 50K in the bank, still less of the billionaires coming in and bringing money. So I'm not sure whether we'll be able to do the guarantees, even though it's nice to have. I'm just not sure that we have the revenues and the capital to be able to do that. And then the last point, and probably the most controversial point I'm going to make, is from a book by one of my favorite economists. Her name is Joyce Appleby. And the reason why I love her is she wrote her last book when she was 85. And she went around the world, so you can see her on YouTube going from country to country, an old woman going around the world talking about the history of capitalism. And one of the things that she said was that capitalism is not an economic system. It's a culture. And it's countries that have the culture of capitalism that actually end up being successful in capitalism. So I think people have touched on it. We've danced around the subject a bit, but I don't think we've really hit the nail on the head. And maybe because it's—
So hit it. So hit it, Ola.
Let us hit it.
Go on, Ola, hit it.
Hit it. So hit it, Ola. Let's go there. Hit it.
I think we should take numbers. I like what Ola is beginning to bring out, which are numbers. Data is king. Data interprets how the facts relate. So let's start with Nigeria. Ola, you're right. We're not a capitalist.
You hit it for me. I didn't have to say it.
Household perspective. I don't doubt that. But take what we call a collective way of how capital.
Please let it be on record that I was not the one that said it. It was him.
Let's take numbers, okay? So let's rely on numbers. So let me look at what, if I look at second quarter of this year, so maybe what, 1.3 billion of foreign capital that came, all right? Compared to 2019, very small, okay? And if you look at FDI, it was Probably you know this number, maybe less than 200 million. Okay? And if you look at what I call fixed capital formation, compared to our GDP, 17%, we are circa 400 billion, right? Dollars. 17% is a scratch of what can be doing, what anybody can do. Okay, but Ola, you mentioned the pension fund. So this pool of capital is scattered and is gray. What we need to do is aggregate. Aliko is 8 billion, I hear you, but Aliko 2 years ago was 20 billion. All right. So, and I like to do this analogy. So I ask people, okay, so a pound is what? The black market is 550 naira or 600 naira, right? So a pound won't buy you an Uber ride from here to our header. But 600 naira will take you from Ikoyi to mainland. So when we begin to make those analogies, there's a little bit of disconnect. However, I agree with you. I totally agree with you. There is no real capital in the hands of people that they use. But if you look at it, if you aggregate it, if you have that culture, 11 trillion naira is what we collected by force. Okay? Now, are there ways to make sure that we can begin to aggregate? Because it's about aggregation. You're right, 60% are below the poverty line. Let me use people back in the day, an example, when GSM started. You and I have had that argument before. So when some people came and did an analysis in Nigeria, they said, okay, they looked at our GDP, per capita, and say, well, you know what, GSM will not work. Let me tell you, people that really did invest worked. When you have 1 naira in Nigeria, you don't have 1 naira. 6 people have 1 naira. And that's the nature of our culture. Now, that 1 naira is flowing down to everybody, and it's not recorded, it's not calculated. However, it's making an impact. So if you look at us as a country, and I like the analogy you use about 30% of what households do invest, directly or indirectly, some of them go to their 401k, whatever it is, but they're all aggregated indirectly. And if I look at CSS, for example, we have a final beneficiary system. We have what, 13 million accounts of a 200 million country. However, other people they do collective, situations and any impacts. So maybe the thinking we should be talking about is how do we aggregate this capital?
But if I may, but why? I mean, yes, we should think about aggregating, but what about the one that is already aggregated?
Yeah.
The pension asset is huge. We're talking
11 trillion.
Yes.
You're right.
15% of the workforce.
And you know what they have done? They've invested most of it in government securities.
That's right.
And what that means is that government is the largest beneficiary from the pension funds. And those funds, they are used by government to fund budget deficits and carry out a few capital projects. And we're talking transformation here. You know, when you fund budget deficits and just do a few capital projects, how do we transform? So now, historically, we know that government has not always been efficient. It's not always been an efficient allocator of capital. Apologies to Yewande but that's the truth. And so, but these monies, they belong to you and they belong to me. And so they can't just be allocated anyhow. And when I was talking about de-risking, I wasn't really saying that everything you have to de-risk. The one that we can start to think about outlets that will be profitable and at the same time protecting people's futures. Okay.
So what we need to fix is the quality of the policy and regulatory environment. For investors who ask for guarantees and protections and indeed incentives, they're asking for those things to counter the reality of the business environment. if the business environment improved, and I don't mean business environment simply in terms of the World Bank rankings, I mean in terms of the totality of what investors look for. And it's everything from policy stability to the, not only the number of people you have in the market, but the quality of the consumers you have in the market and the ability of those consumers to sustain, an investment prospect. And then government policies that are stable for the life of the investment, and government and regulators that act in a manner that the guidelines provide for. So there's some level of predictability. If investors had a greater level of predictability, and expect it to play out in that manner. If they cannot, then they will ask for protections to give them that. Then they will ask for guarantees and incentives to give them that protection.
Very interesting. I mean, so many new things, aggregation, policy, and in fact, I like what Abiola came up with because I looked at the numbers for the pension assets. Truly what we've invested in infrastructure is 0.2%. So it's not even just in aggregating, it's the policy, government policies around how they are utilized. I knew that this panel was going to be really exciting, but I think it's time to move on. So thank you to everyone. I'm going to speak to our participants. We have a Q&A box. Please put in your questions. There's ample time to do the Q&A. And you can see how hot this power fire panel is. So they will take on everything that you throw at them. So let's just narrow down a bit. And I want to hear your thoughts around the remittance flows. Nigeria is currently number 5 in the world in terms of receipts from her citizenry abroad. Other economies are reputed to use those receipts much better than we have. It appears we haven't even been able to capture what the numbers really are. So that tells me that it's just flying all over the place. If you look at the CBN says $17 billion. The Bureau of Statistics says 25 billion. PwC says by 2023, we're going to over 30 billion. This is a lot of money. And what I like about it is it really doesn't have an exit date. So what can we do differently in that space? Abiola, you spoke about how government has used FPIs really to stabilize exchange rates and on the macros. This is the kind of money that can come into play in that regard. What can we do in terms of model structures? What can we do differently? We have more Nigerians flying out. I mean, Jared Cohen said we should look at it from a more positive light than to cry that skilled labor is leaving the country. So these volumes will grow. What can we do differently?
Honestly, the truth is that both the traditional and digital remittance companies have not really developed any specific use case or cases to enable local savings or investments in Nigeria. So what you find in a typical life cycle of a remittance into Nigeria is that it starts with a European or foreign bank account. It flows into a Nigerian bank account, if at all, and then it ends up in cash for bills payment. That's it. We're predominantly a cash-driven economy, and 95% of the commerce is cash-based. So this 25 billion that you spoke about, $25 billion, I choose the number of the Bureau for Statistics. Yeah, it's real, but we need to innovate around the cash in and cash out for remittances. That's the truth. And what the traditional and digital remittance companies have done is really to charge fees. But there's a lot, because what we need to be thinking about is how can we leverage this into true capital that engenders growth and transformation through savings and investments. That's what we need to be asking ourselves, because that's a significant amount. At some point, I think it was even side by side with our foreign reserve, if not more. So we need to innovate around it. Now, the truth is that we will find that there are a few bottlenecks. You know, you want to know the KYC, you want to know a few more things, details about what the foreign migrants are doing, you know, so that they can take advantage of these savings and investment in real estate or pensions or whatever. But all of that technology can actually help us to achieve that very quickly. And so we can solve some of these payment solutions and try to see how the local fintechs, you know, can integrate directly with, I think they have to integrate directly with the international players so that the free flow of cash around, across borders, especially into Nigeria, can be well captured and also then used and build products. Because the truth is, at the end of the day, market participants also need to create the right products. Today, I don't think those products exist. And so the in and the outflow of remittances have been they haven't really been leveraged to give the right wealth or the right capital for growth and transformation in this country. So we need to create some innovation around that so that the liquidity from diaspora remittances that exists, you know, can actually give the kind of value add that we require. Today, we don't have it. And I think it's something that we need to think through.
Yewande, at your commission, are you doing anything about this space in particular?
So we worked with, there are 3 studies that are out there on diaspora remittances. NIPC did one with DFID in late 2017, early 18, to try to understand the nature of these diaspora flows and whether there was an investment opportunity that we were missing. In reality, we found, not surprisingly, that the bulk of the diaspora flows are meant for consumption. They provide cushions for families that don't earn sufficiently. Only about 30% of the diaspora flows that comes into Nigeria is for investment. And the investment that the diaspora flows largely goes to is real estate for the person sending the funds for their family. So again, it is some sort of investment, but it is still consumptive in nature. I think it's important also that we understand that the Nigerian diaspora, only for the first generation, is there an affinity for Nigeria that is not tied to returns or the quantum of the returns. So for first generation diaspora, they're happy. They're less concerned about the quantum of the return they get on the investments. They're more likely to go into areas that potentially are riskier from a geographical perspective. They're not as concerned about the quantum of the return. Once you move beyond first generation, they're no different from, you know, the next investor. It is about the quality of the returns that they will get. And there isn't as strong an association with Nigeria beyond the first generation. And from the study that was done, the majority of the diaspora would love to invest in Nigeria, and they make the right noises, they make the right comments about investment in Nigeria. But the bulk of them actually don't have the capital to invest in Nigeria. Mind you, I'm not talking about all diaspora, I'm talking about a basket, you know, that came from a study. But so anecdotally, those things sort of ring true. And when we thought in NIPC about domestic capital aggregation, we didn't think there was sufficient depth to separate the diaspora from the domestic. We thought what was important is domestic capital aggregation, you know, domestic direct investment. In the same way we have foreign direct investment, we need domestic direct investment. We should not be talking about a handful of wealthy Nigerians that have the capacity to provide capital. We should be talking about every wealthy Nigerian that supports private equity vehicles. The vehicle that Abiola works for is out of Tunisia. It was funded, they raise capital from all over the world. In reality, it is possible for Nigerian private equities to raise capital largely from Nigerian investors. But even the private equity firms in Nigeria, you'll find a vast majority of them would have raised capital from a variety of sources, local and foreign. And in my view, Nigeria should be trying to get as much foreign capital as we can. In fact, we should be trying to get more than our fair share of foreign capital. Across Africa, we're only able to attract 3% of the global FDI flows, only 3%, even though Africa accounts for 16% of world population. Now, if Nigerians themselves participated more in providing capital, and when investors are going through stages of development, in reality, they need a wide spectrum of capital. It's not only banks, because as Ola has very eloquently explained, there's some risks at a stage in a company's life that banks simply don't have the appetite for. That's not what banks were created for. It is people like you and I who are more likely to think in the context of what this can become without as much of a focus about a return, and not have the discipline of banks that say, every month, every quarter, this is how much now investment focus. It is more for family support and probably reflects the reality of our family situations and the percentage, the number of people that we have across the country that are on the cusp of poverty or below the poverty line. It looks like Ola is itching to speak.
Yeah,
so I was just going to say, is that necessarily a bad thing? I mean, like GDP is, it's investment plus consumption plus exports plus government spending. So as far as you're getting consumption, you're getting more GDP. It's growing the economic, pie, no matter which way you look at it. Consumption is a huge proportion of economic of our GDP, and a huge proportion. It's going to make up a huge proportion of our economic growth. So I love remittances. I don't know why, we're being so negative, they're only using it to eat. Yeah, well, eating is good, right? Right?
No. We're not against, I'm not against diaspora remittances. I imagine if we did not have the diaspora remittances, how much worse many situations would be. So the consumption that comes from it is good. But looking at it from an investment, I can see. But looking at it, but if somebody asks me about investments and diaspora remittances, there's a gulf between what investors need and what diaspora remittances come in for. So it was only in that context.
Yeah.
The way I think about investment as an entrepreneur is not that I need external money. And if you look at all the companies across the world, they actually don't make money. They don't take investment from external sources. They take it from their returned earnings. So the greatest source of investment is returned earnings. And the greatest problem of a lot of Nigerian businesses is not that they lack investment. Because if you go to any bank and you show them very good cash flows, they'll give you investment. They lack consumers. They lack people with the money to buy. And that's why I am a big fan of remittances. Because remittances provide consumption. And if we can grow if we can grow that amount.
Haruna is coming after you. Haruna is coming after you.
I'll be super excited. But I think the policy ideas around remittances should make it easier for people to remit. They're paying 30% of the total money that they're even spending just on fees. So I think that we should be lobbying and using our diplomatic outposts to make sure that we lobby America, lobby all the places that the money is coming from, and say, look, you guys, we need to find a way to make our financial systems work, so we reduce those fees. And then also, just on the healthcare side, Cuba actually produces doctors for export. And what they do is the doctors all over Cuba remit part of their salary back to Cuba. And that's actually the biggest export in Cuba. So this year, Cuba is about to make $16 billion from remittances from doctors that they've been sending all over the world. I know when Cuban doctors arrive for COVID, everybody gets excited that these people are so kind. There's no kindness, it's a business. But they have managed to make more from exporting doctors than we make from oil and gas in terms of government revenue to the rent to the government. So I think remittances, if we think about remittances in different terms, we're exporting our doctors for free. So I think that there's a super, important mindset around human capital as well, and how, we can utilize some of those business models. Apart from, this is just my wild Cuban idea, or even in terms of remittances. I think if we can find a way to increase it, reduce the fees, make it easier to send this money and get more consumers, get more money into the hands of people, that's a good thing on its own.
And I think that's part of what Abiola was saying about leveraging technology. Okay, Haruna, I'll send it back to you.
Can I ask a question?
Yes.
We all live in Nigeria. We're assuming from Nigeria, right? You have friends abroad, right? And you send them, please, can you go and get me a bed sheet across the street? Send it to me and send me a Nigerian account number. I'll pay you in Naira. Oh, don't worry. Don't put it in my account. Send it to my sister. What's that? No, seriously. So we are fixated around what is a number for remittance because it's coming through wire transfer. There's more remittance in Nigeria than there is that officially comes as dollar and pounds.
Yeah, for sure.
That remittance, we have to see. So we have to think a little bit differently in trying to understand data. When we do, then we can make informed decisions around how we can make policies. That for me is remittance. I have a friend in London, her name is Fumi. I'm not sure she's on the call or anything. I'll call Fumi, please, can you help me get something, blah, blah, blah. I say, okay, Jalo, can you send it to my sister or my brother or my cousin or something? That's remittance. Now, that's an informal remittance. We need to make it easier for that money to flow in. The reason why I'm doing with her is because I go to my bank, they tell me don't deposit more than 200 Naira or don't do this, do that. What do? I look for an alternative. And that is it. If you make these things easier, there's so much quantum of transactions that go along. Every day I go into my car, I'm looking around Lagos. There's transaction going on every corner, every piece. It's not recorded. Now, what do we need to do? Can we make it inclusive? How do we bring in those transactions that would aggregate into even a tax net? Let's say, for example, even into production in the real sense, entrepreneurship is on the street everywhere. Ola is not the only entrepreneur. The next town to my house, there's a guy selling that card. He's an entrepreneur. Come on. He has very little capital, but he's selling something. He's doing something. Now, what do we need to do? Is a question that we should ask ourselves. How can we make it easy for these little entrepreneurs to grow? How can we have an opportunity for them to create? Well, I said retention. Retention is one way, but guess what? There are 3 levels of money, okay? It starts from before mezzanine, angel, mezzanine, PE, all of that. It goes through the whole chain. These guys don't know this. They only know one thing. How can I turn 1 Naira into 2? And I don't want restrictions around how I can do it. Gospel of capital. We must begin to realize that we must, like Yewande keeps saying, and I like what she's doing at NIPC. How can we make it easy? Not just for that Oyibo boy with the foreign portfolio that comes in and talks to Ola and gives her a private jet. No.
We want that too, but we want more than that.
Yeah, exactly. So we keep thinking, look, there's so much going on in this country. We just are ignoring how to. SMEs, for example, contribute to the largest employment anywhere in the world. So when pandemic came, look at who's suffering. Is the restaurants, the dry cleaners, the bars, that is what creates, so when you talked about GDP, when you calculate GDP, right? The quantum of GDP that makes growth is actually on the lower level of what you're saying. Ola. So we need to focus on how do we create that environment, support everything we need to do to create an enabling environment for that to flourish. If we don't do that, there will be more Boko Haram than you think in Nigeria than anywhere else.
Ease of doing business.
Not just for foreigners, so for us locally here.
Yeah.
You know what I'm saying?
Yeah.
Ease of doing business is for investors. It's not about foreign or domestic.
Exactly.
No. So I guess Haruna is saying domesticate it also.
As well. No. Like I said, she's doing. So we need to also lower it to the what I call SME, pre-SME, because that's where the whole commerce happens. You can buy Ororo with a spoon. That's commerce. Why did we tokenize milk? We were the first to do it in Nigeria. Because of the nature of our economy. You buy every day, you eat every day, bus driver comes, doesn't have tomorrow. That's the way to do it. Nestle is doing it, Cadbury is doing it, so why not?
So, Haruna, you just set the tone because the next question is coming right back at you. You've touched on the MSMEs and how they play such a massive role in the economy and influence more lives than any major corporate can. What can we do? Because, you know, every time the banks get bashed, but the truth is, I personally do not believe, yeah, he's smiling, but that's the truth. The banks get bashed, but I don't believe that the stage or phase of life where the MSMEs are, where a lot of MSMEs are, that they should be touching debts. I think they should still be going equity, but it appears that there are not a lot of platforms. So I'm wondering, are we doing anything in the capital market space to create those platforms where there is long-term funding for them, more than the banks can give?
So the truth is that any of the two, when it's too much, is bad. There has to be a balance of the two. And forgive me, my bankers are going to shoot me today. Let me tell you how bankers are rewarded. Let me tell you how they're rewarded. They're rewarded because of current account balances. Once you can bring deposits, you grow faster than the guys that create products. Yewande, you know that very well. So we focus on the wrong thing within the industry. You will see a guy, all he does, or a woman, all she or he does is bring deposit and he gets promoted every day. The second set of people that get promoted in bank faster are the treasury guys who trade the money. Where are the product people? The products are the ones that say, okay, we have, bank is about intermediation. You collect, you earn, you lend. You put risk management at the bottom, and then something happens. Where is the quality of the products to lend to these MSMEs or whatever it is? I'm sorry, it's not there. A few of them are trying to do it.
It's changing. It's changing.
But it's not changing enough. You can walk to a bank in the UK and say, I have a business plan, and they give you money. In Nigeria, go and try it. They'll ask you, where is your grandmother? Where is she from? Are you related? Before you even, so the concept of products has to change, not just from banking, even in the capital markets. We have to begin to think about, so there are two things people forget. In any financial market, it's about two people, investor and entrepreneur. That's all. You don't need two. You don't need more than that. An investor protects him. An issuer, make sure that when he comes to take money from an investor, it's utilized and he pays back or he does something. You have to bring them together. So how do you bring them together? It's about products. You say, okay, I look at your profile, this is what I think is good for how you can do this, put it in a bucket, then investor come, issuer, you come. This is how we do it, make sure that you, it's a
segregation again.
There's a question around on the Q&A around unclaimed dividend. Maybe we'll get there. But guess what? I'm not joking. The financial market's about two people. It's not about us intermediaries. It's about the investor and the entrepreneur, which I call an issuer. You have to match the two and make the playing field so perfect for them to continue to have harmony. If you don't, you don't have a financial market.
Yeah, but how are you going to bring in the MSMEs who are unstructured by nature?
So it starts from products. So banks have to come lower than to go and be buying treasury bills and bonds and, you know, do intermediation, syndication and all of that. No, they should also come lower. See, our biggest commerce happens below the line. Our biggest employment is below. Government is the biggest employer in this country. The next person is Aliko Dangote. Okay? The rest maybe are banks. What about those people that actually wear rucksacks and do deliver issues, things? Somebody was talking about OP and all of why it happened. Look, the building foundation of any economy, go and check. Whether Keynesian, supply side, demand side, rests with the entrepreneurs that are on the below the line, which is SMEs and MSMEs. That's how economies grow. And now, if you don't address it, you and I will be talking grammar every day on this webinar. I can tell you for a fact.
Ola, they said you are not the only entrepreneur. but at least you are the only entrepreneur on this panel. So tell me what kind of product you want to see from the capital markets.
So I'd like to actually agree with Jalo. A lot of people feel, mainly because we're in Nigeria, that banks are not supposed to lend to SMEs. But actually, all over the world, banks are the biggest financiers of SMEs. So if you read financial literature, which you can imagine, I've been on study leave for 3 years, so I can start citing, giving you citations, you find actually in financial crises, small to medium-sized businesses during banking crisis, when there's a credit crunch, small to medium-sized businesses in Germany, in Europe, in America, they suffer the most because they don't have alternatives. A big company can go to the equity markets, can go and do a commercial paper. They have options. But really, the effects of the banking crisis really hit the SMEs hard because they don't have any other options than the banks. So in a lot of countries, it's when you're small that you go to the bank. When you're big, you have other options. You can float, you can do commercial papers, you can, 50% of some of these countries are in shadow banking anyway. So there's lots of options for larger companies, but very, very few options for small companies. And definitely in countries like the UK, the bank is sort of the centerpiece for the SMEs. So that's the first point. The second point is around the way that developing countries are structured compared to developed countries. So there's a Harvard study that looks at the number of companies and the size. And there's a very nice graph, which I'll post on my Twitter again. I've posted it loads of times, but I'll post it again, where it shows that in Africa and developing countries, there's a huge number of these micro businesses. And then there's a huge drop, almost like a valley. It looks like a valley on the graph where SMEs are supposed to be. Then it rises back up for the small number of big businesses. Whereas in developed countries, you see a very small number of micro businesses, a huge number of these SMEs, and then it goes down towards the big businesses. So you can see that we have a missing middle in Africa. We have a missing middle in developing countries. And what can we do about that? What kind of products do we need? We do need SME financing, but the banks also have a problem. There has to be money in the bank. When you have a low rate of savings, like we have in Nigeria, then the banks don't have money. When you have a high reserve ratio, so that a huge proportion of the bank's money is actually crystallizing at zero in CBN. It's not making any money, it's not working. So when you have a large CRR, and then you have a discount rate set that is very high, and you find out that banks are actually liquidity constrained. So this is back to the monetary policy issue, right? If you have a tight monetary policy, where a lot of the money is crystallizing at CBN at zero, that is supposed to be lent out, then they don't have money to lend. Whereas when you look at China actually had a very loose monetary policy. So the policy there was to make as much money, they had a high rate of savings, first of all, and then as much money was in the banks as possible. So they had the opposite problem to Nigeria. Banks were giving unreasonable loans because the liquidity was there and they did not even know what to do with it again. So I think that it goes back to what we've been saying. And I'm not going to put everything on government because I said that we don't have a culture Jalo said that we don't have a culture of capitalism. I just nodded my head in agreement that maybe that's a cultural issue. There's a cultural issue as well. So I can't put everything on government, but there's definitely a policy issue. You can't expect banks to fund SMEs when you're operating quite a tight monetary policy where banks are actually constrained. And I think that the CRR now, the proportion of money that the banks cannot spend is huge compared to any other country that is growing. So we need to, change that. And obviously there are trade-offs involved. So if you change that, there are other trade-offs and there are other things that go wrong with the economy. So I guess the reason why they call economics the sad or miserable science is because, my mom always used to tell me when I was growing up that I could have everything that I wanted and I could be everything that I wanted to be. But when I started studying economics told me that you have to make trade-offs. And if you do one thing, then another thing may go wrong.
Trade-offs.
Okay. If I may. Can you hear me? I just want to do this a bit because
3 seconds, because I want us to take some Q&A.
Okay. Yeah. In terms of products, I think that for the MSMEs, obviously, if you look at the capital market and you can adopt some of the quick wins there for the MSME, I think it will work. But I wanted to speak specifically about products. And there are products that are technology driven. There are some platforms that you can use as an SME to raise funds. And they are very efficient. They're not, because SMEs are very cost conscious, and so you have to find ways for them that would not be so expensive. So I tell you, the technology-enabled platforms via the introduction of what people probably call blockchains, and people think that these things are far-fetched, blockchains are here with us, and they are financing SMEs and introducing small-scale markets. And today, actually, Nigeria is the biggest source of blockchain trading volumes on the continent. It has more than $34.4 million trading in Bitcoins. And the thing about, and the second rival is just South Africa. And the thing about it is that with the digital currency, you can actually have a lot of scalability. And I think it's something that MSMEs should explore, because when you have it also, it's also a natural hedge. If you were holding a Bitcoin in 2016 when dollar was what, 156, and today your value still remains the same. And so we've seen, and what we are observing, that a lot of MSMEs actually can begin to look out and look at opportunities to use this technology-driven platforms to raise money. Okay, 3 seconds is over, sorry.
Okay, so thank you very much. As we begin to round up, I think we probably have time for just 2 questions. And I'm seeing that a lot of the participants would like us to talk about the situation on ground between the PE firms and local entrepreneurs, with Health Plus on the forefront at the moment. Please share your thoughts around that.
Well, I would not want to preempt anyone, but I think it speaks directly to me. But I just would like to say that when you have matters of this nature and you are not fully involved because you're not part of the agreement and the shareholders, and it's in court, I think it's best not to make judgments on public platforms like this, to be honest. I don't think we're best suited to talk about it, and I don't think we should. But up to you, moderator, but this will be my own comment, to be honest.
Yewande, you want to jump in?
Yes, thank you very much, Abiola. I was going to say, what the public sees are little pieces on a jigsaw puzzle. You don't know whether it's a bird, you don't know whether it's a house, you don't know whether it is, So it is best not to comment on matters on which you do not have a full view. I know that the public is very interested, and I personally wish that the matter was not so publicly discussed. But other than that, it is difficult to comment from an informed position when in reality we are all uninformed.
Yeah.
So really we should wait for it to unravel before we start to take positions.
One thing is sure as night follows day, this film too will end, and we'll see whether we'll see what
like half of a yellow sun right behind you, which you raised funding for.
You probably just think that they have settled and they've moved on, but like you said, let's see how things evolve. I don't think.
Okay. And then we're going to this one that clearly has Haruna written all over it. So people believe that the unclaimed dividend running into trillions is probably another asset we should seek to harness. Haruna, what's your take? You're muted, Haruna. You're muted.
Yeah, sorry.
Okay.
So dividend is profit made by company and paid to shareholders, right?
Mm.
And when shareholders don't come to take it, it becomes unclaimed. Now, shareholders are owners of the company. What ordinarily should happen with the money? You ask me, it should go back to the company so that it can plow more, create more value for the individual. Kama was very clear around what you should do with unclaimed dividend. You want to remind me, I think it's 12 years. And then
yes.
Go and claw it back. But guess what? So again, the new management SEC is trying to simplify how this things work. But the problem with unclaimed dividend started from how we bought shares from early days. So you have a prospectus, which Yewande used to do very well, prepare it very nicely. At the back of the prospectus would be the application form. You fill the form, there is no KYC on who you are, you write a check, and then you attach a check to the form, and then you send it to the issuing house, or let's say the agent who takes it, and then so the check goes to the bank, that form goes to your registrar. Nobody validated whether your name was correct, whether you filled it correctly. Nobody knew whether you had a number that was correct. Maybe it's 5 digits instead of 11. You didn't have a bank account put on it. So when we start CSCS, what we find is that 70% of our data that we have in CSCS is incomplete. Mm. So you find that somebody would buy shares and put Jalo Waziri, number 5 Marina, and says Anambra State. And then puts an account number that is 3 digits or 4, just because he wants to fill the form. So it's around the quality of data that sits in the capital market. That is the primary reason why we have unclaimed dividend. What are we doing about it? So we now have a checkpoint. So today, when we onboard you in the capital market, we do 3 levels of verification, or 3 things that we verify: your name, BVN, account number, and then ensure that the number, the telephone number you give us at least is complete, even if it's wrong, before we take in that data. So that is going forward. What are we doing looking back? So we, working with the SEC, the registrars, the brokers, we've developed a new system to say, okay, anybody that's going to trade today in this market, we must make sure that all of the KYC is done for you. Just like you do post-no debit, PND, in a bank. We have started doing that at the capital market. So before you trade, your data must be complete. Now, can we fix what is done over 20 years? It will take some time. However, what we're trying to do today, or what we're doing today, is make sure that whoever is onboarded, whoever is going to trade, whoever is doing any movement within the capital market must validate his data again. It's like DSTV. You call them and say, please, can you upgrade my account? The first thing they ask you, is your email still this number? Is your telephone number this? Is your address? That's what we're doing now. It will take some time. It would still be there, but it won't grow exponentially like it used to. And then we're working backwards to make sure that it's clean. Gradually. It's a lot of effort, unlike a lot of effort.
Okay, Haruna, there's another question here for you. Good conversation so far. My question is for Haruna on the informal flow of capital on the streets. Are there fintech solutions or products that can capture these informal inflows?
God bless that guy. I don't know his name, but let me check. So the thing, blockchain, we talked about blockchain, we talked about fintech. What is fintech? Let me tell you, people like to do things very easily. People like to find the least part of resistance to do a transaction. People like to, look, why is Uber so successful? It's so easy. Hailing a taxi is just a mad thing. You sit in your house and say, okay, 5 minutes downstairs and there. It's about ease of, let me put it this way. It's about least part of resistance. I strongly believe that this thing that we have is the infrastructure. Forget the roads, forget the fiber you're putting. It's all to support this. And if you're not inside here in future, you're dead.
That's it.
So, yes, we need to bring that bridge between what happens on the streets to the ease of doing business on this format. USSD, apps, whatever it is, it could be something different, but it has to be around what we carry every day. This is our identity. And if you're not here, if you're not dealing with this, I'm sorry, you're not anywhere.
Thank you very much. I mean, the session, we have to round up now because we must sign out at 4:30. It has been a very interesting conversation and a very fun panel. I'd like to actually sit with everybody in one room. I know I'm going to have a blast. Thank you to all the panelists. And I will, sorry to our participants, there are lots of questions, but we really can't take any more. So I will leave it to the panelists. What is your final word? What is the one thing you're going to say, Nigeria, you need to start to do this from today? I will go to Yewande first.
How is this fair?
How did I know you would say that? I knew you would say that. Yewande, you know I love you. That's why it's coming to you first.
So what do we need to start doing today? In reality, I mean, I've worked in government now 4 years. The quality of plans about what we would do to take Nigeria to the next level, the quality of the conversations we have on panels like this, almost humbling in terms of what is possible. The reality of doing, though, is a wide gap. Many Nigerians think that once they have voted, they have done what they need to do. We know people who work for government, you know the kind of people who work for government. We all need to do a little bit more. Actually, we all need to do a lot more than talk about what needs to be done and actually get involved in getting it done. And it's a lot more than just voting or making intelligent comments on panels like this.
Thank you, Yewande. Dr. Ola Brown, what do we need to start doing now?
I think what we need to start doing now is acknowledging, and I've said it before, I'll just repeat myself again, acknowledging that we can't have it all. I think, maybe because of our religious inclinations in Nigeria or things that our parents told us, we think that we can have everything together. We think that we can have cheap electricity, and we think we can also have investors like flooding in and not paying cost-reflective tariffs. We think that we can have it all. And unfortunately, as I learned in economics, it's contrary to what my parents told me. You can't have it all. You have to make trade-offs. So what we need to start doing now is trying to make some of those difficult trade-offs.
Abiola, because the man in the house needs to really end this. That's the slam dunk. So Abiola will come to you first.
Okay. I think I'd like to just conclude on this note to say that money or capital is indeed fungible, and it doesn't really have any preference in terms of destination. It will stay here. It will stay in my village in Ijebu. It will stay anywhere as long as the environment is right. So private capital in a form that works for the intended objective is actually crucial for sustainable development, and we need to mobilize it now. But we must also know that the macroeconomic situation is an important part to mobilizing that capital. And so money would flow to the most diversified business-friendly economies. I hope that the next time we have to speak about this, money would flow to Nigeria because we've done the right thing. Just to say also that we appreciate the reforms. Government needs to focus more on reforms. They're already doing it. We know PEBEC and all of that, but we need to do more and we need to sustain it. And I believe that if we do the right things, speaking as a private capital participant, money will flow. Thank you.
Okay, so Mr. Jalo Waziri.
I'm likely to get in trouble for what I'm going to say, but let me try and put everything that everybody said. We worry about how power is gotten, not how power is used. And I'll explain. We worry about the process in terms of getting people into places to help administer us or to lead us. We don't worry about how, when the people get there, how they use it. And I'll use 3 examples: Ethiopia, Rwanda, to a certain extent, one other country. It's not about the process. It's about what Yewande said, execution. We worry too much about the process of how we get somebody to go and do something for us, rather than focus about what the person is going to do for us. All of this thing we're saying cannot happen if we don't have the people who will do, and it starts from my councillor in my area, to the local government chairman, to the my elective House of Assembly, to my House of Reps, to my senator. It just starts from there. We worry too much the process rather than we have good plans, like Yewande said. We have the best ideas, but it starts from understanding that the process is not as important as the use of the outcome of that process. Until we address that, we can speak grammar tomorrow, P or no P, flying doctor or not, we must address those issues. And if we're able to do it, then maybe Lee Kuan Yew will come and turn on his grave and say Nigeria has changed.
Thank you. So we end on that note, and a massive thank you to my panelists. I'm going to have lunch or dinner with Yewande when she's in Lagos or when I'm in Abuja. You see, I'm taking it aggressively. Thank you, Dr. Ola Brown. Thank you, Abiola. Thank you, Haruna. I had such a brilliant time. And to the rest of Nigeria, execute, execute, execute. This is the message that the panel is sending out to Nigeria. It starts with not just government, holding government accountable, holding each other accountable. Everybody has a role to play. We hope the next 60 years will be a 60 years that we revel in because we're better for it and our children are better for it. Happy Independence Day, Nigeria. I wish everyone the very best. Thank you.
Thank you very much.
Thank you. Thank you.
Thank you.
Thank you.
Thank you all.
Bye.
Thank you.
Bye.
Lovely to see all of you. Take care.
Bye-bye.
Bye.
Ndidi, you owe me lunch, oh, I'm coming for it.
Am I owing you lunch or you are owing me lunch? Yewande, come on now.
Of course you are owing me.
Okay, no problem. I know what I'll reap from it.
Got it wrong.
Game night.
Thank you. I'll give you a call, Yewande.
Take care. Okay.
Game night.
Jalo, love to the family.